Investors Chronicle.
Hello and welcome to Lee and the IC. I'm Alex Newman, an associate editor at the Investors Chronicle in the FT studio with John Lee, one of the UK's most successful private investors. John, how have you been?
Fine, thank you. Watching the market carefully, trying to interpret some of the moves that are taking place globally.
Nice. We'll try and interpret some of the moves you've been making in your own portfolio as well on the back of those. First, the quick perennial disclaimer that nothing we talk about on this podcast should be taken as investment advice or an invitation to buy or sell shares. It's all for education and entertainment purposes. It's Monday, the 14th of July as we record, after another 2-month hiatus. That means a large list of changes to catch up on, lots of reader questions to address. But John, before we turn to your portfolio, the buys, the sells and the observations therein, can we start with the wider picture for markets? I mean, when we last spoke, the picture was dominated by tariffs and what might be rising protectionism. Stocks have since continued their tentative recovery on the whole, but it's hardly a happy picture out there if we're sort of reading the business headlines. The UK government is struggling to tackle its fiscal challenges. There's this continued brinkmanship between Trump and the rest of the world, and then you've got the other drumbeat of threats from geopolitics to the climate, currency, demographic crises. They just seem to be getting louder. How are you managing to stay level-headed?
Yeah, the grey clouds are still there.
Yeah,
quite clearly. There is this huge amount of global uncertainty with, as you rightly say, the tariffs, Ukraine, Gaza, the Red Sea, and I suppose the big change. A negative change has been, unquestionably, the UK economy has deteriorated, and it looks as though tax rises are going to be inevitable. And of course, there is speculation as to whether the government will move towards some form of capital taxation, wealth tax in some shape or form, and of course, there's also been quite a debate about cash ISAs and whether the Chancellor was going to trim the amount one could put into cash ISA to try and encourage more people to actually move to stocks and shares ISAs. So, it's been an interesting period, but not a great deal has changed.
I mean, as for that market reform questions on ISAs aside, I'm struggling slightly to see where the stock market fits into the government's growth agenda. I mean, I get some emails from listeners who, I think, by dint of how close you are to, the Lords, etc., and how closely you follow what the government is doing, who are interested in any take you have on where the stock market fits in the government's view of the growth it's trying to pursue.
Yes, I don't think it's difficult to discern what the government is trying to do.
Yeah.
But I think that there is quite a gap between their broad aims and what actually comes out in specific legislative terms. So, obviously, to take the simplest, I mean, the idea that you encourage growth in business and employment by banging on increases in national insurance surcharge and an increase in the minimum wage, and then wonder why firms aren't expanding and taking on more people. It's bizarre. And then, of course, we've also got some negatives. I think business would view the coming employment rights bill as being quite negative. And then, of course, the handling of the non-dom situation hasn't been clever. And so one doesn't doubt the lip service to a growth economy. But, when one looks at some of the actual things the government is doing, I'm afraid one is rather less than convinced. And obviously, the market is unsure of just what's going to happen. It does look as though, from what Andrew Bailey said recently, that interest rates are probably going to start coming down, which may be helpful. But there are so many uncertainties there, and I suspect are going to be there for a long time.
Yeah. Let's turn to your portfolio. can start with M&G, which is, I think, still your largest holding. At the end of May, the company announced a deal with the Japanese life insurer Dai-ichi, which joins you, I think, on the shareholder register, or is set to join you on the shareholder register. They've said they're going to take a 15% stake in M&G through on-market purchases. In turn,
I think
M&G...
they're going to end up with a slightly larger stake than
Right.
I've got, I would say. Although you are absolutely right, it is my largest holding.
Yeah.
Yes.
I think then in turn, M&G is going to become their preferred European asset manager, asset management partner. And the two companies have sort of entered into this slightly, it's interesting but slightly unusual mutually beneficial arrangement. What's been your take on
Well,
what
I
this means?
regard it as an M&G shareholder. I regarded it as a very positive move because a major Japanese insurer and Japanese generally don't move quickly. They do their research. They're pretty careful about who they get into bed with, and so the very fact that they have announced this deal with M&G, I think is a considerable feather in M&G's cap and Andrew Ross's cap for having negotiated it. Just confirms my view that M&G is a very attractive business from an investment point of view. I think it's excellent because it clearly has moved the M&G share price forwards. And also, clearly, more business is going to come in from the Japanese. They more or less said that, which is going to be very helpful. I mean, the yield on M&G, which I thought was extraordinarily attractive at sort of 10.5%, 11% at one stage, on the rise. The yield is still about 8%. So it's still very attractive from an investment point of view. The only thing that did surprise me that I thought was slightly strange was the decision by the Japanese to buy their 15% in the market, which is really quite rare because in a way it almost puts the price against them. And I've not seen any announcements, so I'm not aware that they have actually made any significant purchases.
Right.
I would have thought the way forward, and the normal way would be for them to subscribe for 15% of the a new capital structure.
Yeah.
And that would have given M&G obviously more firepower as well, and given Dai-ichi the 15% they want in a more certain form than having to buy in the market. I suppose the other point just to be conscious of is that if anyone else was going to have a serious look at M&G in terms of a possible bid, they're clearly going to have to make a move. And there's still time to make a move before they actually get the 15%, as it were, and then I think it would be very difficult for an outside predator to gate crash the party. But I think at the moment it's still uncertain what is actually going to happen because they haven't tied that 15% down.
I suppose it's almost, well, it's not a misnomer, isn't it? It could certainly push the shares up, as you alluded to, and it's a strong show of support if they do reach 15% or whatever level they. But it's almost secondary, isn't it, to the deal providing all this, this capital flow and extra business, isn't it? Because I suppose with M&G, one of the bare points against the investment case is that it's all about their use of capital and the potential for that to get bogged down in the movement of interest rates and long-term assumptions. But this deal kind of it suggests that actually there is a value in financial services businesses which doesn't always get reflected in their price, being their know-how and their expertise in a market where Dai-ichi clearly
I think
are
that's
light.
fair enough. I think it also is probably very good from a global point of view. Clearly bringing in a major investor from the Far East, and obviously having a lot of local knowledge as well. So whichever way you look at it, it has to be a good deal for M&G, and from my point of view, very, very pleasing.
So staying for a moment with developments in your existing portfolio, and I suppose global developments, last month we had PZ Cussons announcing the sale of its 50% stake in its Nigerian edible oils business, or as a joint venture. So it sold it to its joint venture partner, Wilmer. We've talked a fair bit, haven't we, about PZ Cussons and its plans, which I think you saw ahead of time to divest some of its business. This brings, if it completes, £50 million back into the business towards debt reduction, a little less exposure to what has been a very volatile market for them. The market reception has been mixed to negative. Why do you think that investors haven't quite bought into the turnaround yet?
Well, I think the main reason is that the whole thing has taken a lot longer than people would have anticipated. And I think people couldn't really understand why the Saint-Tropez business, which they announced they were going to sell, the tanning business, wasn't sold very quickly. I think they can understand why there is a much more complex sale situation in Nigeria, given that the business is so big and there is a quoted company there, and you've got the Nigerian government and currencies. So that inevitably has taken time. But the company, I think, has been a little remiss in not really keeping investors up to date with continuing talks. I know it's difficult because obviously until something is finalised, you can't really make an announcement, but it has dragged on. Anyway, we've now seen the first tangible part of the sale process or the divestment process by the, as you say, the sale of the palm oil business to Wilmar. And so, there seem to be another two parts to go. One is the joint venture that they have with the Chinese hire in white goods, and it remains to be seen, how much they sell that for. And then, of course, there is the big business, the big trading business with the brands and the factories and the manufacturing operations in soaps and toiletries and cosmetics and what have you. So, sort of one down and two to go. And of course, the other thing that I think slightly disappointed the market was that because Saint-Tropez had been trading poorly, clearly PZ weren't able to get anything like the sort of price that they hoped for, I assume, and therefore have withdrawn that from the sale process and are going to concentrate on rebuilding that using a selling platform called Emerson's in the States. So we shall see. So meanwhile, the price has been sort of treading water, drifting a little. No one quite sure what's going to happen. But bottom line, I remain confident that, assuming that they do manage to divest from Nigeria and from Africa, that then you will see a much cleaner and clearer situation with the UK brands and the businesses left in Australia and Indonesia, and we should begin to see a significant upward movement in the share price.
So your long-standing loyalty is not clouding in any way your sum of the parts valuation?
I'm still in optimism mode.
Good. On to ingredients maker Treatt. Been another sort of difficult holding. When we last spoke, I think it had seen a mini rebound on the back of its very disappointing and unfortunately timed April trading update, which I think had detailed fading US customer sentiment and I think having some quite tough time with sustained high citrus prices. It's been fairly flat trading since, despite half-year results that sought to project confidence. And one listener, Matt, wanted to know how you've coped with the mental challenge of seeing one of your biggest winners turn out to what he estimates to be one of your bigger laggards in the last couple of
years.
Yes,
I mean, it's obviously very disappointing when you see something that was worth a very substantial amount of money worth a lot less. I mean, I did manage to sell a proportion of my holding. I can't remember. I think about 20% higher up, much higher up. Well, I think I sold some at £8, £9, £10. I think they reached about £12, and where are we now? About £2.50. So it's a mixed tale. I mean, I'm still, making a very sizable profit on my original purchase price in 1999, but nevertheless, quite a disappointment. So where are we now? I'm certainly holding what I've got because I do think just as they were probably significantly overpriced, I think they're probably somewhat underpriced now, and little more than asset value, and almost debt-free as well, and two very, very, very modern state-of-the-art plants in Florida and Bury St Edmunds. So I suppose my slight surprise is that a predator hasn't appeared, and I think that has been the general feeling that they were very vulnerable and indeed still are. Meanwhile, obviously we're watching their basic trading performance, and they have to go some to achieve the second half projections which they made. So the jury is still out, but it's now, from being by far my largest holding, is now a very useful holding. But it's not one of my major ones now. But there's a lot of emotion and sentiment attached to it, put it that way.
Another listener, as well as I suspect a few others, have wondered what you made of Louis Hall's decision to sell a chunk of his shares in the software group Cerillion, moving on to another holding, which I think has done very well for you. Long-term listeners may recall that we interviewed Louis on this podcast last year. What did and his, I think his shareholding has been like it is for lots of other companies where there's a founder or a key person with a large holding. It's a big attribute for you. What did you make of his decision to sell?
Well, I've had a huge respect for Louis, and I think he's done a great job in well, first of all, leading the buyout from Logica some years ago, and then bringing Cerillion to market, and it has been a great success story. Interestingly enough, when we interviewed him 12 months ago on this podcast, on this program, he was extraordinarily optimistic, if you recall, about the business and the potential opportunities they had. He said, and I think still only have, like 1.25% of the global market in their sector, and he was really talking very, very optimistically. What has slightly disappointed me over the recent months has been that they haven't announced any new significant contracts, and I really was expecting that they would announce one or two. Given my experience with Treatt, where one was sitting on a very substantial profit, as indeed I was and am with Cerillion, I decided to do a little trimming myself. And so the shares, the Cerillion shares went up, I think, to about £19. I sold a small portion of mine at about £17. And then, of course, it was announced that Louis Hall himself had sold a percentage of his shares. So now, the shares are just over £15 and recovering. So I always think it's disappointing when, you see a key shareholder selling some shares, but on the other hand, he still retains a very substantial proportion of his holding. So slightly disappointing, but it's not altered my sort of fundamental view of the company, and I'm still retaining the majority of my holding.
Well, on the theme of selling shares in companies whose CEOs we have interviewed on this podcast, I understand you weren't too happy with Braemar's decision to halve its dividend.
I think that would be fair comment. Yes, Braemar was cheap when I bought it, and is still very cheap, I think, as a stock. But of course, the shipping sector has been quite difficult. Particularly with tariffs and China and the Red Sea. So I don't think Braemar has been trading, possibly quite as easily and profitably as it originally was hoping. But where I did take exception to was the decision of the board. I think it was particularly James Gundy himself who really, because he was so frustrated with the share price and didn't believe that they were getting any sort of plus rating for the improvement in profitability, really decided to slash the dividend, to halve the dividend, to buy back shares. Now, I'm a great believer in dividends for all sorts of fairly obvious reasons, and I wasn't pleased with that decision at all. And in fact, it's not been particularly successful from a share price point of view, and actually the shares are, have sort of drifted down steadily. So I reduced my holding in Braemar quite significantly. Still have a small holding, and thought I'd move to pastures where there was more of a commitment to the dividend. In my view, Braemar would have been better off just being a little more patient with the share price, hopefully delivering an improvement in bottom line profitability and edging the dividend further forward. And I think that would have started to bring about an upward re-rating. But I think taking the view that slashing the dividend was going to be beneficial, I'm afraid I wasn't buying that one.
It's interesting, isn't it? I mean, buybacks are certainly in vogue in the UK market, or have become a lot more readily used in the last few years, but don't always seem to work.
I've no problem at all with companies buying back their shares if they have surplus liquidity. But what I'm not keen on, obviously, are companies reducing their dividend to buy back shares. And we've got a lot of major PLCs buying back shares at the moment, but they're also maintaining or increasing their dividends. And that's fine from my point of view. But to slash the dividend to retain the cash to buy back shares, I don't think is the way forward.
We're going to touch on some of those companies. I think you just alluded to then that you have since turned your eye to. But finally, on the sell side, you think you reduced some of your position in supermarket income?
Yes, I've sold my supermarket income Reit entirely. It wasn't a huge holding, but I thought that the shares were attractive, and indeed, in a way, still are attractive. They were on a big yield and a significant discount to assets. And, I sold not because I formed a negative view of the company, if anything, the opposite, because I think, the company are actually making strides to increase bottom line profitability, bringing in extra capital. I think they've just announced the acquisition of a Tesco site in Ashford in Kent, I think. And so, I think it's a very good, solid business and probably going to grow at a faster rate. But I think that discount narrowed to some extent. And I decided on balance to take my profit and move into one or two things where perhaps growth is greater.
It definitely seemed a theme with any re-rating that has been happening with the investment trusts in the last couple of years, that it never quite gets, well, it's not going to get back to the levels it was 4 years ago, but these rallies can peter out a little bit once investors think it's...
And that is what happened. And so I was quite happy to take I don't normally take short profits, but I did in this case because I wanted some cash for one or two of the new ideas.
Okay, so I think we've got two new positions that you've opened up. Coincidentally, one of them is a company that a listener, Adrian, kind of amazingly had emailed to ask if you would consider the shares, but not on the back of his recommendation. You bought them independently. But I think what he saw in them were Mancunian roots, a strong yield, and lots of John Lee style attributes. I mean, can you talk to me a little bit about James Halstead? What led you to the stock this time round?
Yes, well, historically, I knew the company well. Indeed, I was on the board for a few years, probably 20, 25 years ago, something like that. So, it has been a great success story over the years. In the last few years, the profits haven't really moved forward, and the share price has drifted down. And it's drifted down, in my view, to a level where I think there is an attractive entry point. It's a very solid, well-established business, a global leader in floor coverings, should benefit from capital expenditure, infrastructure spend in this country in terms of hospital expansion and school expansion, perhaps prisons, things like that, where it sells its floor coverings into. And like a number of those family businesses, like Nichols and Thorpe's and James Latham, it's got a lot of cash, so there's no question that the dividend at all is at risk. There's a nice 5.5% yield there, and it's one that I very comfortable to buy, and it does tick a lot of the things that I look for.
A flooring business, I mean, you'd imagine in the last 20, 25 years that sector has changed markedly from a global perspective, and I know their polyfloor business is quite international. Are they still a competitive proposition?
I think that very, very competitive, because I think these big rollers that they've got, that probably they've written off in value years ago, as it were, can continue to churn out variants of the floor covering. I think they're probably as and it's not. I don't think it's over labour intensive, and therefore I think they can be as competitive as almost anyone, and have really built up, and great credit to them, a very successful global business. Very happy to have them in the portfolio again.
You've also bought short shares in Cars, which, I mean, regular readers or listeners to the Investors Chronicle might know is one of Simon Thompson's bargain shares for 2025. I mean, a brief overview is probably warranted here, isn't it? We've got a company, it sold its engineering division, I think announced that at the end of last year, and then has spent this year promising to return these funds, which are around £70 million, to shareholders via a tender offer. It did that and completed that tender offer last month. So it
Yes.
bought back 45% of its shares, about 163p. What's the timing been then with your holding? Were you in before the tender offer?
I was in a little before that.
Okay.
Yes, a little before that, and an interesting. I mean, I obviously I've been aware of Cars for a long time. It being a northwestern company, and one of the three companies in the animal feed sector. We had Cars, we had NWF, and we had Winstay. So they all had sort of common agricultural characteristics, feedstuff characteristics, but they had all diversified in different ways. NWF in terms of storage of food products, big storage business. Winstay with a chain of country stores. And NWF, of course, had a big fuel distribution business. And Cars diversified out of agriculture into engineering, nuclear engineering. As you rightly say, they have sold most of their engineering interests, are returning or have returned cash back to shareholders, which means that the agricultural side, which they can really concentrate on now, is basically a debt-free business. They've got no debt, which is a big plus, and brought in a new younger management team now that the business is solely focused on agriculture. And I think one is getting in at around the ground floor of what could be quite an interesting growth story. Interesting enough, the chairman of Cars is Tim Jones, who was the chairman of Treatt in its golden period. So I'm hoping that in a way. He brings a little of that gold dust to Cars.
So just to clarify, you bought in and then immediately did you accept the full 45%?
No, I didn't. I didn't sell any of my shares.
Okay.
I just let it pass by.
We're just going to conclude with a couple of updates from companies been a long-term holder of. The first being Christie Group. That is a company that provides brokerage, agency, and stock and inventory services to the hospitality sector. It's quite a thinly traded stock.
Very thinly traded, because the controlling Gwynn family, have got, I think, pretty well half the capital. David Rugg, the former chief executive, has got him and his family about 10%. I'm disclosed as a holder of around 6.5%, which I have to say are not all my beneficial holding, but shares where I'm combination of my beneficial, which is a significant holding, and also non-beneficial holdings that I influence. So there isn't a great deal of free market in it. It's been a long-term holding. It has been disappointing, but the big transformational was the sale of their loss-making stock-taking business, high street stock-taking business, for Wilkinson's as it was, and no doubt Boots and Next and large companies. And that lost money and dragged the bottom line down. And they sold that, 12, 18 months ago for £5 million, which means that they're now debt-free. and also free of the millstone of that loss maker. We've started to see some real bounce in the bottom line profits, a doubling of the dividend, and I think I think over the next 2 or 3 years one is going to see quite significant bottom line growth. And I was delighted to read recently of their participation as brokers in the sale of a large Marriott hotel with 330 odd bedrooms in Vienna, which obviously is a considerable feather in their European business cap. And will bring, I'm sure, a very nice commission, well-deserved commission into the business, because they are a pan-European broking operation with 15 or so offices in this country and 15 overseas. And given the volatility and uncertainty in the hospitality sector, where they are, which is probably their main core area of focus. Obviously, a lot of hospitality businesses, because of the aforementioned national insurance hikes and similar, are struggling. There is quite a lot of movement in buying and selling of and raising finance, people moving out, others moving in, consolidating, seizing the opportunity to go to take on some good new sites for restaurants and similar. And of course, what Christie's wants to broker is movement in the sector. And that is unquestionably what we are beginning to get at the moment. So I take quite an optimistic view of Christie's over the next few years, because they're not just in hotels and restaurants. I mean, they are the lead broker in care homes, in nurseries, in veterinary practices, in pharmacies. So it's a far more valuable business than the present capitalization indicates.
Another business which I suppose had a slightly more conglomerate style or diversified roots, which seems to be narrowing based on the success of one of its divisions, is MS International. They just published their results. Like I said, until recently, quite a diversified business with interests in, I think, petrol forecourts, forklift trucks, etc. They still have those interests, but now they're very heavily geared towards defence spending, which I think, as we've spoken about on this podcast before, relates to some of their, both their sales to the US defence industry and in the UK. I mean, they're trading on something like 11 times net income based on their the most recent results, which I think there's quite a big discount to some of the defence names UK investors might be more familiar with. What did you make of the results and the outlook?
I was pleased with the results, and they moved the dividend forward nicely. I think I sort of had the impression that I think they'd hoped for one or two more contracts than were actually placed. They are probably the global leader in small caliber naval weapons, and major suppliers to our Navy and to the German Navy and to the American Navy. So it is a valuable niche business, which, as you say, probably has been under the radar for some time. But I'm still very much aboard, and I think the slight drift in the share price does present another buying opportunity. I think also that there are trials of their anti-drone weaponry for land use. I think the Americans are looking at that, and if that were to come off and result in orders, that could obviously have a very significant beneficial effect on the overall group. So whichever way you look at it, I think they are a very solid business with a lot of cash and a valuable defence business, which is probably undervalued by the market.
It's quite a quiet company as well. I mean, we're hoping at some point maybe to have them on this podcast, along with a few others we've mentioned, which by my count, I think we've covered 10 stocks in this absolute whistle-stop tour of your portfolio, John. So appreciate your energy in fielding my multiple questions on all of those companies. Next time we meet, maybe we can hone in on one or two, hopefully maybe catch up with some CEOs as well in the coming months. Let's leave it there. If you've got any questions you'd like to put to John for next time, suggestions for future guests, you can do so by emailing me at alex.newman@ft.com. But until then, all that's left for me to say is to thank you for listening. Thanks, John, as ever, for your thoughts,
pleasure.
and to our producer, Maddie Upthorpe. So until next time, goodbye.